Ever check your bank account and wonder, where did it all go? Welcome to Australia in 2025. Everything costs more, but paychecks haven't caught up. We're stuck in an economic limbo. Slow growth, stubborn inflation, high interest rates, and a mountain of debt. It's not just numbers. This is why your groceries feel like a luxury and your mortgage reads like a ransom note. So, let's grab a bucket and see just how many holes are in this sinking boat. Time for the ugly details. First, GDP growth is crawling at 1.5%, way below healthy levels. The pie isn't getting bigger, but everyone wants more. Unemployment sits at 4.1%. Sounds good, but wages aren't keeping up with costs, so your paycheck buys less every month. Inflation? Still at 3.6%. That's why your coffee, groceries, and power bills keep climbing. The RBA's weapon? Interest rates at 4.35%, the highest in over a decade. Borrowing is painful, mortgages are brutal, and spending has slammed to a halt. The RBA's strategy: make us all spend less by making us poorer, hoping prices will finally cool off. It's a sledgehammer approach, and everyday Australians are the collateral damage. So, the numbers aren't just bad, they're shaping every part of your daily life. Let's dig into that sluggish GDP and what it really means for everyday Australians. We're going to unpack the numbers and look at the human impact of this economic slowdown. At 1.5% growth, we're barely moving. It's like trying to drive uphill with the handbrake on. This isn't the kind of growth that creates prosperity and opportunity for everyone. Living standards are stalling, and for many, the economic pie is shrinking. Real wages are stagnant, and the cost of everything from groceries to electricity keeps climbing. It's a tough situation for families just trying to make ends meet. High interest rates have slammed wallets shut, putting immense pressure on households with mortgages. Every rate hike adds hundreds, sometimes thousands of dollars to monthly repayments. People are cutting back on everything, triggering a vicious cycle. Less discretionary spending means less demand in the economy. Less spending means less business, and small businesses, the backbone of our economy, are feeling the pinch. Fewer jobs as businesses struggle to stay afloat. They're forced to reduce staff, contributing to rising unemployment, and even more anxiety. The uncertainty about the future is weighing heavily on people's minds. Take construction, a sector that's highly sensitive to interest rate changes. When rates were low, building boomed. Developers rushed to start new projects, creating jobs and driving economic activity. Now, with borrowing costs sky high, new projects have dried up, leaving half-finished buildings and a sense of unease, hurting everyone from builders to hardware stores. The ripple effect is significant. This slow growth makes investing a minefield. The stock market is volatile, and investors are hesitant to take risks. Retailers and hospitality are struggling, with many businesses facing closure due to reduced consumer spending. While only essential services or export winners are holding up, shielded from the worst of the downturn. For most, it feels like running a marathon on your knees, exhausting and unsustainable. Technically moving, but not getting anywhere. Progress is slow and hard-won. The bottom line, this isn't just about numbers on a spreadsheet. Slow growth means fewer opportunities, more caution, and a lot more pain for Australian families and businesses. And unless something changes, with bold policy decisions and a renewed focus on growth, that pain isn't going anywhere. Inflation and interest rates. These two economic forces are constantly battling, shaping our financial landscape in profound ways. Understanding their interplay is crucial for navigating the complexities of the modern economy. In Australia, they form an economic tag team from hell, constantly wrestling for control. Their combined impact dictates the cost of living, investment returns, and overall financial stability. Inflation stubbornly stuck above the Reserve Bank's target band, refusing to come down easily. This persistent inflation creates challenges for both policymakers and everyday Australians. It's making everything from haircuts, a simple everyday expense, to insurance premiums, a necessary safeguard, more expensive. The rising cost of goods and services is impacting household budgets across the nation. The RBA's answer to this inflationary pressure? Jack up interest rates aggressively, pushing them to 4.35%, a level not seen in quite some time. The central bank is hoping to force prices down by making borrowing more expensive and reducing overall demand in the economy. This is achieved by squeezing household budgets, leaving families with less disposable income. Since May 2022, we've witnessed an unprecedented series of 13 rapid rate hikes, a relentless tightening of monetary policy. This constitutes the fastest pace of interest rate increases in modern Australian economic history. For anyone burdened with a mortgage, it's been nothing short of a financial gut punch, significantly increasing monthly repayments. The RBA is making a calculated bet that it can successfully crush inflation without triggering a full-blown recession, a delicate balancing act. However, with economic growth already showing signs of weakness and slowing down, it's undeniably a dangerous game with potentially severe consequences. For investors navigating these turbulent times, this translates to a landscape where uncertainty rules supreme. The key question is, will interest rates remain elevated for an extended period, ultimately choking off economic growth and investment? Alternatively, will the RBA eventually blink and reverse course, opting to cut rates in an attempt to stimulate the economy? But doing so risks reigniting the very inflation they're trying so hard to tame, potentially leading to another surge in prices. The truth is, no one definitively knows the answer to these critical questions, and that pervasive uncertainty is precisely the core of the problem we face. In this complex and unpredictable environment, what is the only certainty we can cling to? It's that ordinary Australian families are unfortunately caught directly in the crossfire of this economic battle. And unfortunately, all indications suggest that this tense economic standoff is unlikely to conclude anytime soon, leaving families in a state of prolonged uncertainty. These numbers aren't just abstract figures on a spreadsheet. They represent more than just data points. They have a tangible impact on industries, both big and small, across the nation. Take the Smiths, a young family full of hopes and dreams who bought a Sydney home in 2021, envisioning a bright future in their own space. But since then, their mortgage repayments have jumped significantly, placing immense pressure on their finances. In fact, their monthly mortgage bill has increased by nearly $2,000 a month, a staggering amount that's hard to ignore. This is all thanks to soaring interest rates, a direct consequence of the Reserve Bank's efforts to curb inflation. Looking at agriculture, farmers like Chloe, who work tirelessly to feed the nation, are indeed earning more for their exports, benefiting from global demand. However, they're simultaneously paying way more for essential inputs like fuel, fertilizer, and the loans they need to operate. These high costs are significantly eating up their profits, making it harder to sustain their businesses and livelihoods. Meanwhile, mining giants in Western Australia are experiencing a boom, fueled by global demand for resources. They're shipping vast quantities of iron ore to China, a key ingredient in steel production. This activity is significantly propping up the national economy, providing a crucial source of revenue and employment. But this creates a two-speed economy, a situation where different sectors experience vastly different fortunes. While mining thrives, generating substantial profits and investment, retail, which relies on consumer spending, faces significant headwinds. Similarly, hospitality, a sector heavily reliant on tourism and discretionary income, is struggling to stay afloat. And construction, facing rising material costs and labor shortages, is also finding it difficult to maintain momentum. The pain isn't shared equally across the board, leading to disparities and imbalances. Some are winning big, benefiting from the current economic climate and accumulating wealth, but many are just trying to keep the lights on, struggling to afford basic necessities and make ends meet. This divide is fueling resentment and social unrest as people feel increasingly left behind. It's making the economic landscape even more fractured, creating uncertainty and instability. The policies meant to cool the economy and bring inflation under control are disproportionately hitting those who can least afford it, exacerbating existing inequalities. In many cases, the rich get richer, further widening the gap between the haves and have-nots. It's a recipe for frustration and disillusionment as people lose faith in the system, and it serves as a warning sign for the future, highlighting the need for more equitable and sustainable economic policies. So, what's the way out? The RBA could cut rates, but not until inflation is truly dead. High rates are a blunt tool, hurting everyone to fix one problem. The government can help with targeted relief, energy rebates, welfare boosts, but must avoid fueling more inflation. Long-term, we need to boost the supply side, invest in infrastructure, build more homes, and train workers to ease shortages. These aren't quick fixes, but they're essential for a more resilient economy. We also need tough conversations about tax and productivity reform, how to make growth fairer and more sustainable. Relying on the RBA's interest rate hammer isn't a strategy, it's a cycle of pain. Real change means rethinking how we grow and who benefits. So what should you do with your money in this mess? Sitting still means inflation eats your savings, but risky bets could sink you. Focus on quality companies with strong moats, essential services, and low debt. These businesses weather storms better. Diversify globally. Australia's struggling, but the world isn't uniform. Export sectors like mining and agriculture are still strong. Be wary of companies tied to consumer spending. They're in the firing line. Stay informed and patient. The RBA will eventually cut rates, but timing is uncertain. Don't panic over headlines. Stick to your long-term plan and look for opportunities in the chaos. And invest in your own knowledge. Because in a world this uncertain, that's your best defense. Stay safe, stay smart, and keep your wallet close. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed. Stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.